Good morning, everybody. Greetings from Shanghai. Today, what I wanted to address, and I think it's a really fascinating subject, is the not even resurgence, but the emergence, really, of the ETF passive market here in the mainland. And before I get into the details of where things stand right now, I need to make a major statement, and that is I have certainly been wrong on this point. For the longest time, I've viewed ETFs and the passive space in China as being nowhere near as formidable of a market opportunity as in other markets. Now, I know that this is, you just can't say these words, ETF, passive, you name it. These things are all most of our clients want to talk about given the construct of markets globally. But that's sort of the issue. There were two primary reasons behind why my outlook for ETFs in China was one where you would never see any material growth, at least in the near term. Number one, just call it market structure. And what I mean by that is the Chinese market does not have much of what is required to support the consistent and ongoing flows into passive investments like ETFs. We see this in the US, Australia, and elsewhere, where whether it's the pension schemes, whether it's issues such as dollar cost averaging or the like amongst retail investors, this is just not how the markets here operate. And given that, it just didn't make any sense to me that the ETF market in China was going to really grow in any material fashion. Just as critical, I think, is the fact that as large as China's markets are, it's insanely inefficient. I mean, the equity markets, I would argue, in China are really an opportunity for, as I remember investment management growing up in the industry, is a market where if you do your homework and you're able to go out, you're able to find assets that are mispriced, and you can genuinely generate real alpha. I think markets like, again, the United States or continental Europe, Japan even, these are markets that are clearly developed, more or less efficient, and that's very difficult. That was never the case in China. So given these two, what I consider genuinely structural points, ETFs were just not going to find a space in China at any point. I have been completely wrong on that. And with that in mind and seeing how things are playing out, taking a 180-degree turn and wanted to sort of bring to light directionality, if you will, of ETFs and passive for the onshore China market moving forward. Now, I think it's super important to understand the why. First of all, the 2 points I just made, they still stand. China yet has any material pension scheme that would support dollar cost averaging, or even, dare I say, an investor base that would understand dollar cost averaging. What is important, I think, here is to focus on what is driving this shift. And what's driving the shift right now is policy. Once again, and I would say this is probably the fifth attempt in the past 25 years, the CSRC, the regulators, in my opinion at least, are making yet another attempt to focus on reducing retail participation in the equity market. Retail participation, ever since I first arrived here back in the late 90s, has been a bit of the bane of the existence of the markets. A lot of the volatility is derived from, emotive nature of the Chinese investor. Boom bust cycles, as we saw in 2015, all the way back in 2007. And I remember 1996 especially being sort of the first real advent of that. And interestingly enough, over that period of time, even the introduction of mutual funds in China back in 2002, effectively, you can call it 1999 if you look at closed end, but the introduction of mutual funds in China was honestly all about trying to tamper down and reduce the level of retail participation. Let's get Chinese retail investors out of directly chao gupiao, right? Getting into the market. And let's get them into mutual funds with professional managers running them, so on and so forth. It didn't work. In fact, I could make an argument that it exacerbated the issue. You also had, the introduction of the National Council, China's pension provider of last resort. This was a group that ultimately was brought in to help, number one, really boost large cap IPOs, meaning that there was a large local investor that could take on, if needed, a supply of issuance. Come to find out, was only needed in the very early days, but overall, getting a large institution into the market theoretically should then reduce the overall participation of retail investors. Again, it didn't work. We saw it again with the insurance companies. Insurance companies were, I want to say 12 years ago or so, formally allowed to begin to expand their allocation for the general account into equities. Again, introduce large institutions. This should tamper down retail participation. Didn't work. And there are other examples, enterprise and occupational annuities being another good example. So it stands to reason that while you will almost certainly witness an increase, and we have this year, in both not just the number of new ETFs being issued, but flows into those products. But we're talking about tens, probably hundreds of millions of individual investor accounts that still remain. Now, all of this, I would say, really kind of inadvertently came about after the sharp market correction that we witnessed in January and early February of this year. The so-called snowball strategies, the small caps, the private funds, whatever you want to call it. And then we had the new butcher, the broker butcher being brought into the CSRC. And it was very clear then, especially with, as we all know, the national team having to enter the market to sort of provide supportive measures. Now, when the national team did so, they did so how? Through ETFs. And, we're seeing this, what I like to call a bit of a, we're not talking Japan. It's not like Japan going into the ETF market as we saw over the last decade. It's more akin to what I'd like to think of as the Hong Kong tracker fund issue from the Asian financial crisis, for those of you who are old enough to remember that. It was a brilliant solution to how the HKMA was able to move out of its overhang of stocks it bought to support the market. What China's doing, I think, right now, especially with the national team, is somewhere in between the tracker fund and what Japan policymakers did over the last decade. But it is without question that ETFs in China are going to become an increasingly important segment of growth in terms of AUM for the industry. I think from the end of 2019 to just the second quarter, what we had was ETF AUM going from, in US dollar terms, roughly about 100 billion US dollars worth of AUM in ETFs here locally. That's gone up to 300 billion just at the end of the second quarter, so end of June of this year. More interestingly is outside of bond fund flows onshore this year, ETFs have basically destroyed everybody else. The flows into ETFs have been mind-boggling. And we see this even on the QDII front. There's been a lot of talk of late of these two Saudi ETFs through the QDII program that were launched. I don't know, they raised like $1 billion, maybe less than that, $500 million or something like that, renminbi. And they're up to about $1 billion each. Now, that growth has come almost entirely from flows. But more importantly is those ETFs are also capped given the limitations on QDII quota. But you're seeing a number of moving parts here. Again, we can argue, we can discuss as long as we want the rationale behind it, should policy be driving it, what have you. Maybe. But I think what is very clear is that you're going to see many more large cap ETFs that will be issued over the coming 6 months, probably into next year. And I think what will be fascinating for me is to watch how this may or may not impact the competitive landscape locally, or even globally for that matter. We don't really see clearly much in the way of demand on the global stage for China. I forget where I was reading somebody else is exiting their allocation to China A shares, what have you. But I think when we are going, not if, but when, we are going to see some form of rebound in Chinese onshore equities, the first beneficiary will be flows into ETFs. That will both most likely come not just from local retail managers or local retail investors, but global investors as well. But I did think it was important to step in today to highlight a subject matter which I know is very top of mind, if not for China, at least globally, amongst many people that sort of follow the content that I provide. And I'll continue to talk about flows in the competition as much as I do looking at the geopolitical headwinds and tailwinds and what else moving forward. But for now, keep your eye on ETFs. I'm wrong, and let's see how it plays out over time. All right, take care, everybody. Have a great day.